Swiggy has declared that its food delivery business has finally turned profitable in the March quarter of financial year 2023. And this is good news because Swiggy hasn't reported profit so far. So it's broken even, and we finally know of a food delivery aggregator that is profitable. Comes on the back of what we've been hearing as disrupting news when ONDC entered the market. But all in all, looks like profits are in the books.
Right. So, ONDC is, while it's been in talk since September, October last year, its real introduction in the formal food delivery ecosystem is just about 2 weeks old or so, maybe a month or so, right? So what we're talking about Swiggy's profitability is again Q4 of last year. So I think the ONDC impact had not really come in by then. But there is a lot to actually discuss about this story, and I don't know if I can request Hamad and Shalini to pull up the graphics here on the screen, and let's look at what we are really talking about here. We are talking about a startup which was a prime unicorn. Unicorn is a $1 billion company. Swiggy had actually broken into the decacorn club, right? $10 billion in valuation. It's not a decacorn right now, but if you look at these numbers, it's taken Swiggy 9 years to turn profitable. In traditional brick and mortar companies, you can't sustain a business for 9 years without making money. So it's investors' sustained investment and sustaining those losses on their books and staying invested in a vision that the founders had. That sort of has kept the company afloat. And it's been growing, of course, in revenue, in users, in average ticket size, in return users. But profits have come a good 9 years later. Right. Now, Swiggy apparently has also stated in a blog that the founder, Mr. Majeti, had written yesterday that Instamart, which is its quick commerce segment, is only 3 years old, but that is also going to turn profitable in a few weeks. So what it tells you is that as a whole, it's taken 9 years for the food delivery business to turn profitable, but it has taken only 3 years or just about 3 years for the quick commerce segment to break even. If not profitable, it'll break even, right? So that is good news, that as you get scale and as you become a bigger consolidated entity, you start eating into your operational efficiencies across departments, and learnings get passed on from one business unit to another, and the path to profitability gets accelerated in such an environment. The next important figure is that last year, FY22, Swiggy had a loss of almost 3,628 crore rupees. This is a big number, and this number actually doubled from FY21, which was at about 1,600 crores.
Okay.
So the graph having moved from a minus 3.6 thousand crores for the financial year to a quarterly profit is sizable, right? So this speaks about a very affluent ecosystem where people are ordering more consistently, are paying the higher delivery fees, are paying the higher rider fees, and are really using these services more than they used to a year, 2 years ago. 2021 losses are understandable, COVID, Delta wave, right? 22, it doubling for the financial year, big number. And now from that number to really go into the green is actually quite impressive. Now, if you remember, Swiggy had also laid off, I think the number is 380, my typo there, not 280. There were 380 employees that were laid off earlier this year. Right. So I think the pressure to turn profitable has been there on Swiggy for a while. Now, two important things. I mentioned Decacorn earlier, right? Decacorn is a $10 billion startup. Now, it has turned profitable, but the profitability coincides with the Decacorn status also being lost. So, if you remember, Invesco has downgraded Swiggy's valuation from $10.1 or $10.7 billion to about $5.5 billion. They say 5.4 to 5.6. Invesco has halved its valuation on Swiggy. Coincidentally, Baron Capital has reduced it, but reduced it only about 30-35% to $7.1 billion. So I think this entire story rakes up a whole new debate on how are startups really valued. And the inverse relationship between profitability and valuation.
profitability,
One would
absolutely.
logically like to believe that as the company becomes more profitable, its valuation should be seen at a higher level. But here, the dichotomy is that it turns profitable at a time when its valuation is reduced by 50% in one instance and 30% by another company. So what is
so
the
the larger
metrics
debate,
of valuation?
And so the larger debate around valuation, where
Yeah.
we play up valuation on big screens, we you know, we are
We celebrate
self-impressed.
115 unicorns, 10 decacorns,
yes,
and whatever
we
not.
take a lot of pride in the fact that we have so many unicorns and decacorns. At the same time, some of these organizations dwindling to make profits, and Swiggy here, great example of why you don't have to be a decacorn, but you have to be profitable, because end goal is profitability.
Absolutely. So end goal should logically be profitability, but like I just mentioned in the case of Indigo as well, fundamental business requirement, or the purpose of being in business is return of shareholder value. So as long as you're able to keep your investors in the green, no matter what your books say, I think you are in an okay position. As long as one investor invests in a business, ends up making some money on his exit or by way of additional capital infusion, as long as anybody who's an investor, whether a retail investor or an institutional investor, is making money by being invested in that business, that of course, is serving the purpose of the business being in existence. But the dichotomy of profitability coming and valuation reducing is of great intrigue, and one needs to sort of study this and see how the math of valuation really works and why this inverse relationship between profitability and valuation.
And one can't let go of a discussion around food aggregator services without talking about the freebies that they have to offer. I'm not sure if you are subscribed to Swiggy One. I know many of my colleagues are, and they talk about savings in huge number. But freebies there, sort of have reduced in the past couple of weeks and months, and that could be one of the reasons why Swiggy has turned profitable.
You're right.
Because there's no free lunch.
You're right.
And you cannot sustain in the business by offering huge discounts. So what we have witnessed, in fact, and I'll bring in the discussion around ONDC in once again, is that sometimes the food menus are inflated and then there is a discount, but net there is some profit that Swiggy or Zomato, its rival, is able to book at the end of each transaction. But I think all these aggregators have now realized that they cannot continue offering freebies, discounts in the long run.
Absolutely, Shweta. And I think you're right, and the observation is bang on. But these freebies, as we see them, are actually a marketing expense for the company, right? So what do you do by way of giving, let's say, a 50 rupee discount or a 10% discount, or or any other scheme, a coupon code which permits you to get a bumper 150 rupees off on a particular order? What are these? These are actually marketing expenses for the company. So it's booked under the P&L, of course, but on the marketing side and not really on the per delivery cost. So that is to broadly understand the books. But what are you spending this money for? You're spending this money on customer acquisition. You could offset this discount by releasing, let's say, full-page newspaper ads. You could offset this cost by releasing television commercials, right? This is marketing money that a company has to spend irrespective in acquiring customers. It's a new form of attracting customers and increasing your customer base. So you make the customer feel empowered that, hey, I'm not spending money on a communication creative which may or may not reach you. I'm rather offsetting that expense straight on your bill, and I'm acquiring you, right? So multiple ways, and yeah, I am a Swiggy One customer. I'm also a Zomato Gold customer, and I'm also a Paytm on ONDC subscriber. So I mean, it tells you how much food I order or like to order. But yeah, I think so. The schemes that they usually toy with are new restaurant. They give you a scheme, right? You return to a restaurant after a long time, they give you a welcome back, right? But once the algorithm understands that you are a regular avid foodie
from that particular place,
and there are certain preferences that you have where you order regularly from, they don't give you any discount.
Absolutely.
Then the discounts they give you are on credit cards. Hey, take this Access card, credit card, or take this ICICI credit card or any other, and then so that these are again bank tie-ups, partnerships that they do. But with ONDC, of
I
course.
want to bring in a conversation around ONDC.
So what is your view on ONDC? Do you think it's actually going to be a disruptor?
Well, to my mind, instantly there has been some sort of uptick. A lot of people are very curious, especially in Bengaluru, not so much in Noida, because there are not a lot of restaurants which are currently on ONDC in Noida. But in Delhi, there are a couple of few. Some of my colleagues here at News9 have tried ordering, and they managed to order, booking some sort of, profit, as in not paying more, paying less, relatively lesser, and that is leading to a word of mouth that is spreading very, very quickly amongst people who uses these apps on a daily basis. And my understanding is, if ONDC tries to run its operations in the way Swiggy or Zomato do, or tries to onboard many, many customers, goes hunky-dory on trying to onboard as many businesses around them, trying to reach out to these businesses, actively getting people on board, then not in the long run, but in the, not in the short run, I beg your pardon, but in the long run, 8 months, 9 months, 10 months, I could see, and I do see them disrupting Swiggy and Zomato's business. I do see them, having some sort of impact on the bottom line as ONDC starts acquiring more customers. Because let's not forget, most of us who buy online or who are ordering food online know what our preferred choices are. We're buying it from a restaurant, either one that we've visited before, or we know where we should be buying our food from every weekend. So in most cases, the restaurant and us as customers already have that partnership, and ONDC is helping you directly reach out to them. The restaurant is reaching out directly to you, and you reaching out directly to the restaurant. So sort of bringing you both closer together, acting only as an intermediary, acting only as a handshake, as opposed to acting as a barrier between the two. And that is going to have an impact on, Swiggy and Zomato's bottom line. Now, I'm not saying that just out of my own assessment of it. We also saw how Zomato took a beating, the stock of Zomato took a beating immediately after ONDC and the news around ONDC was announced. So much so that they had to come on record and say, we are fine, we are here, and we are not looking at our any sort of bump in our operations. So we are actively still acquiring customers, and our operations and our profits haven't really turned negative. So don't go by what you are listening, because there's such a hullabaloo and such a loud noise around ONDC in the past couple of weeks. It's faded a little bit. I'm not sure why that is, but one needs to understand that ONDC has to operate from a place where private entities operate, that is, be very aggressive in acquiring more sellers, more restaurants, onboarding more services. Because you remember, we spoke to Chief Business Officer of ONDC, and he said that it's not just about food services. You'll soon have medical services. You'll be able to book a cab. So we're looking at one app doing it all. Something that, that's been sort of a dream for a lot of people who have 20 or 30 apps, from booking a cab to ordering food to medical services. Net, so many apps. If all of that could just, combine together and give us just one app where we can do it all, I think everybody's going to prefer that.
Great, excellent insights, Shweta. I just have 2, maybe 3 concerns, right? If let me take them one by one. Number one, we understand ONDC is backed by the government. It's plug and play e-commerce, and profitability is not the core reason for ONDC's existence. However, to sustain ONDC, losses will also not cut it. So my point is, ONDC will also only have deep enough pockets to sustain these discounts which are being offered either by restaurants or ONDC directly, or the aggregators like Paytm or Magic Pin, as the case may be, only to a limited point. So customer acquisition, which again, the marketing cost around acquiring customers, would be offset only to a point, and beyond which these irrational deep discounting will have to cease to exist, right? So this is my first sort of contention with ONDC being a game changer disruptor. Yes, it will enable a lot of other small restaurants to ride on ONDC without paying the 15%, 20% commission that they pay Swiggy or Zomato. But the second point, and I'm leading to that, the second point is that I doubt well-funded, deep-pocketed, now profitable Swiggy and Zomato will not be caught napping. So I think market forces will get them to reinvent and figure out ways of keeping their customers with them. This could be through extended loyalty programs. These could be through other bundling of, of other goods and services. This could be whatever. They've got very smart marketing teams. They've got excellent consultants on board, and they've got venture capitalists with insane experience in investing and keeping startups in India and internationally afloat and maybe profitable. So they will come out with great counter theories
and one of the big
practices.
counters, and I think I have to say this, from the point of someone who's been tracking this, and all of us have been talking about this for a while, one of the way to do this would be to plug into the fear that we keep your data safe, which is what ONDC is not promising.
Yeah, so ONDC is saying, I am not transmitting your critical details back to the restaurant. But anyway, so yeah, you're right on data security as well. But I think that to explain to an Indian audience is going to be a little, little difficult, because we are not very data savvy yet.
Is correct.
So the point is, these guys, Swiggy, Zomato and the likes, are also going to reinvent. And if they face a serious threat from an ONDC driven supply chain, they will reduce their commissions. They also need to stay in the game, right? So they will make more incentives for suppliers, restaurant operators to continue being with them for the service that they provide, right? The third thing I want to elucidate through an example, and I'll do it quickly, I know we are almost out of time. Yesterday, through one of the quick commerce websites, I'll not name it, through one of the quick commerce websites, you ordered a lot of stuff, including a loaf of white bread, along with some cans of some beverages. Now the bread actually came broken into half, because when it was packed, the cans were stacked up on top of the bread. So there were slices of the bread broken, and the entire shape of the bread loaf was a nice, beautiful U shape. So I was actually confused. Did we order a pretzel or did we order a bread? But anyway, it was a white bread. So it came broken. It took me perhaps 2 minutes clicking a picture of that bread, uploading it back on the quick commerce platform, few message exchanges with a chatbot stroke human being. I don't know, it was pretty good. So it was hard to decipher. One phone call, do you want your money credited back into your wallet linked with that quick commerce app, or to the source of payment? My source of payment was UPI. I said source of payment. Within 5 minutes from the time I raised the complaint, I had my 50 rupees on that broken bread back, and I got to keep the bread as well. Right. Now, in such a beautiful customer experience scenario, can individual sellers, individual restaurants, or individual operators who will use third-party delivery vehicles, will they be able to offer the same customer experience? Because for me, for an urban Indian who values time and convenience over most other things, one of the prime reasons why we really go after these quick commerce applications is for the time and convenience, right? So if that customer experience is not lived up to, I'm not jumping gun to an ONDC platform.
Not jumping ship, rather.
Not jumping ship, sorry, to an ONDC platform.
Not jumping. Karthik is not jumping ship, but I think all in all, the discussion boils around how easy and convenient it is to order food through one of these quick delivery services app, as opposed to ONDC, which is just foraying into the market. You know that you're going to be directly talking and transacting with the restaurant, which may not be able to offer you same sort of services, and will not be making your life easy in case you want to exchange, you want to give it back. It's not the quality, the taste is not good enough. So all of those, of course, will remain prime concerns. We run out of time, Karthik, but interesting story there coming in from Swiggy at this point in time, which has finally turned profitable after 9 years in operation. We will continue to track all those stories and more. Keep watching News9.